My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends. I'm just trying to make you some money. It's my job, not just to entertain, but to educate, put it in context, teach. Call me, 1-800-743-CBC. Tweet me nicely, please, as you always do, at Jim Cramer. When you break out that bandwagon analogy, you break down the rally. Last night, I talked to you about how so many analysts, hedge fund managers, and strategists came out of the woodwork and came on air to say, now is the time to get in. They're finally ready to embrace my peak inflation thesis and jump on the J-Powell bandwagon. But like I said last night, these people are late to the party, turning it, frankly, into a virtual Donner Party. And when these sunshine bulls start getting vocal, it means the market's about to stall out. Entirely. Sure enough, the Dow dropped 117 points, the S&P lost 0.72%, and the Nasdaq tumbled 0.125%. Think about it. This rally kicked off more than 2 months ago when all these same gas bags came on and said it was the beginning of a bear market and we were going down, down, down. They warned that oil was going to the moon. Diamond hands. Because so much Russian capacity had been taken offline by sanctions, and they saw long-term interest rates soaring. Thanks for nothing. Since then, I don't think you could be more dead wrong about a prediction. Every one of them. You know what they are? There was this sort of King Midas in reverse. The stock market's had an amazing move. Oil's going into bear market mode, and the bond yields are down big since then. Selling 2 months ago was the exact wrong thing to do. And you were half a year late into the decline. And now the S&P 500 is up 18% from where they told you to sell, 18% from the bottom. I think going positive yesterday was also a bad call. You know what these people do? It's an anti-investment strategy they have. They like this. They like to sell low and buy high. Now, I'm not some kind of oracle, but I don't use the bandwagon insult lightly. I saw too many signs of complacency and froth yesterday. Those signs are still very much with us. Let me go over what I saw on my radar that's so disturbing. First, today's decline notwithstanding, this market basically hasn't quit since mid-June. That's a long run. The market's gotten overbought, as judged by the S&P oscillator that I've sworn by 35 years. It has been at +6, which means we're due for a pullback. Let's say ripe for a pullback. How accurate is the oscillator? Listen, I decided to get much more positive about stocks in the second week of June when the oscillator hit -10. That's an extreme oversold, rarely seen position because it's double-digit minus, and that is really important. I said you had to hold your nose and buy because historically it's almost always worked out. And that's when we high-graded the charitable trust, getting rid of marginal stocks and doubling down on our favorites, while adding a few names that have been obliterated, even as there was nothing wrong with the underlying companies. We pounded the table for investment club members daily, why I always say you should join, and drilled it home daily on air at our 10:20 a.m. morning meeting that I host with Jeff Marks exclusively for club members. But now we're in exactly the opposite situation. Now I think it's time to take something off the table. Take some profits in stocks that have done amazingly well over the last 2 months, especially the ones that you may have bought aggressively near the bottom. And that's what we started doing for the club today. Sell, sell, sell. Now let's talk about my second concern. The Fed. People have gotten way too complacent about the Fed. You think commodities down big in the last couple of months, that J-Powell's really going to stop tightening? We know what that would be. That would be wrong. The Fed's going to be less aggressive than we expected 2 months ago, but they're still on the warpath. We learned that when they released the Fed minutes today at 2 p.m. While there are many deflationary forces out there, from sub-$4 gasoline to inventory gluts at major retailers, we're going to talk about that later, crumbling commodity prices, you have to understand that the Fed's most worried at this point in the cycle about wage and housing inflation. And they still haven't made a dent either. So many people retired from the workforce because of COVID and never returned. So it's hard for businesses still to find workers even now. The job hoppers continue to get outside raises, too. I say congratulations to anyone who's making more money, But you need to know that a severe labor shortage is massively inflationary and not sustainable. The Fed will not stop until the job market cools down. At the same time, we have a housing shortage, and even as mortgage applications did indeed hit a 22-year low today, prices are still too high. Unfortunately, the home builders saw this coming, so you know what they've done? Very intelligently, they've held off buying aggressively, and that just creates artificial scarcity. Home prices are up roughly 30% in the last couple of years. The Fed wants to roll that back. Who can blame them? It's right. It's inflationary. It's bad. And please don't even get me started on rents, which are even worse. In other words, the Fed's not done. The market did rally hard when they released last month's Fed minutes, and we've learned that some members were concerned about doing too many big hikes too fast. Fine, all well and good, but they're not done. They're just going to be more deliberate about it, which is exactly what they should be. That's why, of course, that the market then gave up pretty much all of its Fed minute-related gains. And those gains were so ephemeral and stupid. It's like the words really weren't that much different from what Jay Powell said, but people like to do things stupidly in the market all of the time. Finally, worse for last, I don't like the froth. This rally started with high-quality stocks being thrown away, okay? But we're already seeing the worst of the worst stocks now play catch-up. I'm talking about the mostly awful companies that came public in the last 18 months, either through IPOs or SPAC deals. These have been in free fall for ages. But they've now bottomed, almost every one of them. And they bottomed on nothing good. They just bottomed because the sellers exhausted themselves. Many hedge funds bet against them on the way down and now near the lows. And now those short sellers are getting squeezed. Moves like that rarely last. That leaves us where we are now, with the worst stocks soaring, having been aided greatly by short covering. At the end of every big move, we get a couple of stocks that become the focal point in the entire market. We caught a terrific short squeeze in Beyond Meat, the incredibly underwhelming faux meat company, back in the summer of 2019. But the S&P 500 struggled mightily afterwards. Same goes for the brutal parabolic short squeeze in Tilray at the end of the cannabis craze, again followed by a savage market decline. Then the apes came into the picture. Opportunistic retail investors who learn that you can break hedge funds that are selling short if you just keep buying the stocks that they hate. Now, we call these stocks meme stocks, which is a good name because they offer excitement but with no real substance. We had the initial GameStop surge in late January of last year. That was followed by a 12.5% decline in the NASDAQ from mid-February through early March. Then we had 6 more of these, 5 of which were followed again by a nasty hit to the NASDAQ, which has led the way higher since June. Average post-meme stock decline is 12% in the NASDAQ. I fear that we could be somewhere like that this time with the short squeezes going on in Bed Bath & Beyond, a failing retailer with a gigantic short position that's now being exploited by buyers in the same way that GameStop was exploited. Except GameStop actually always had a really pretty good balance sheet, while Bed Bath wrecked its balance sheet by borrowing lots of money to buy back stock and following that up with a failed merchandising strategy. If you want an analogy, Bed Bath reminds me almost exactly to a T of JCPenney. Now, this stock was at $4 and change a couple weeks ago. It closed today at 23, though it's plunging after hours after memester-in-chief Ryan Cohen filed to sell a substantial portion of his position. Funny how that works. Why did this crummy stock go up at all? Aggressive gang tactic of short sellers. It might not be market manipulation, but I think these people orchestrating this one, let's just say they should get good lawyers. If it continues, and I think it will, then we could see another big pullback like we saw after almost every other meme frenzy. Yes, the froth in that is bad. It's that bad because it's a sign that the rally's run its course. Here's the bottom line, though. Things can still go right. I don't want to freak you out. I just think that stocks need a cooling-off period after this miraculous run, and we're getting one for certain. And you should take something off the table, too, just as we do for the Charitable Trust, because that's exactly what you do when the bandwagon is out, because the bandwagon almost always tips over. Rachel in Florida. Rachel.
Hey, Jim. I'm a regular caller at this point, so thank you for taking my calls. Love the morning meetings. Yeah, I love the morning meetings.
Thank you. 1020.
Throughout the day.
Yeah.
My question today is about Square. I'm down a little over 65% in the stock. I love the company, but great companies don't always mean stocks. I feel like they do solve a problem, though. I have a long-term investment horizon, like 30 years. Would you suggest that I buy more, lower my cost average, hold it, or take my losses and invest in a higher quality stock?
I think we have to have Amrita Ahuja back on. I think we have to have her back on. I'll tell you why. She's the person who talks doors, she never speaks. because I think they have a coherent, terrific strategy, but the stock just went up too high. I agree. I share your enthusiasm for what they do as a company, but they are a $47 billion company, and I think it's probably really only worth about $30 billion. So you can hold on, but expect some volatility and some more downside. And thank you for the nice words about the 10-20 meeting. I think stocks need a cooling off period after this miraculous run, and that's exactly what we're getting, and then we'll resume our rally. On Mad Money tonight, Pioneer Natural rang the opening bell in honor of the company's 25th anniversary. I just catch up with the company's CEO. And off-price, but on the money, I'm taking a closer look at the discount retailers, see if any pose enticing buying opportunities. And Karuna Therapeutics soared last week after releasing positive phase 3 on its hopeful schizophrenia treatment. And I'm digging into the date with the company's top brass. I like what I see. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.